If you're a retiree today, you've likely heard about all the tax benefits of Roth conversions, and that may have you feeling like that's the only and the best option for lowering your lifetime tax bill in retirement. But depending on your circumstances, Roth conversions may not be the end-all be-all solution. We're living in an era where taxes are on sale. In such a time, you may want to prioritize tax gain harvesting over a Roth conversion strategy. Long story short, you have options. In this case study of a retiree I work with, I'm going to help you determine if you should prioritize Roth conversions versus tax gain harvesting. I'm Brad Lineberger, certified financial planner, founder of Seaside Wealth Management, here to help you get more out of life with your money. Let's crunch some numbers. All right, in order to set this up, we have Rob and Maria. Of course, the names have been changed to protect confidentiality, but you get the point. And they both had a brokerage account, taxable brokerage account with about $400,000 in it. Maria had an IRA with $400,000. Rob had an IRA with $540,000. And they both had small little Roth IRAs, and they owned their home. And so the question that they were asking me is, should we take advantage of doing Roth conversions while we're in this lower tax bracket? They're 63, they just retired. Their income went down, so their tax bracket went down as well. And the only real income that they had Social Security income coming in. Their plan was to live on that taxable brokerage account. They had a little bit of money in cash. They were thinking about living on that and then doing Roth conversions. So I want to show you how we approach this. And the first thing we did, I want you to look at scenario 2 here. This is the known information, which was Social Security income. So we plugged that into our tax planning software, $37,000, and you can see that none of it was going to be taxable. So keep that in mind. And then the resulting federal tax bill in this one was going to be zero. In other words, at this point in time, with just Social Security income, there was no taxes owed. So we started to play around with the numbers and we took a look at the tax code, and what we saw, we said, all right, what if you guys did a $90,000 Roth conversion to transfer money out of that traditional IRA and over to the Roth IRA? What would that do for you? And we saw a couple of things. So what we saw by doing the conversion, now more of their Social Security income is taxable, $31,450. So that's the first thing to note. Another key takeaway was that they're still in the 12% bracket, so that's a good news. And the resulting tax liability for the conversion is going to be about $9,718. So it's going to cost them $9,700 to convert $90,000 from the traditional IRA to the Roth. And we looked at that, and so you can see that they're squarely in the 12% bracket right here. But we saw that there's still a little room to run between where they were and the top of that 12% bracket. And to be precise, there was actually $7,000 of room to fill up that bracket. So we said, okay, if their goal was to make the largest conversion that they could, and then but remain in the 12% bracket, we went back and we edited our work and we said, okay, what if we did a $97,000 conversion? What does this look like? And then based on that, there you go. So tax went up slightly on the additional conversion, but we got them right there to the top of that 12% bracket. And now they've converted almost $100,000 from the traditional IRA to the Roth IRA. So now we have to contrast that with the great question they were asking me. They were saying, what's more valuable, the Roth conversion or selling investments from our taxable brokerage account and paying nothing in capital gains tax? So now let me walk you through that scenario, and then at the end, I'm going to help you make a decision about what's best for you depending on your circumstances. So in this scenario, we'll focus on scenario 4 here. This is the one where instead of doing a Roth conversion, what they ended up doing was they decided, let's sell investments from that brokerage account and make it a goal to sell investments and pay nothing in capital gains, because they sure liked tax-free. Who wouldn't, really? And so couple cool things. By doing that, they're in the 10% bracket, which is fantastic. And once again, they're going to pay nothing in taxes, which they liked. So total tax bill of zero was exciting to them. And so let's take a look at this one here. They were able to realize the same amount of total income, and yet they paid nothing in taxes. And when we went down here and we took a look at it, we saw that their taxable income was right around $89,950. And then this is the key, you guys, as you're planning for this, the thing that you need to understand. As long as you keep your income underneath $96,700, if you're married filing jointly, you are going to pay nothing in long-term capital gains rates. The minute you go over $96,700, now you're going to be in the 15% bracket. And then once you cross over $600,050, now your long-term capital gains are taxed at 20%. And I'm just curious to know how many of you guys are in the 15% bracket versus the 0 versus the 20? Leave a comment below, I'm just curious. So when you look at this, the long-term capital gains is running on 3 different brackets, where our ordinary income system is running on 7 different brackets. And so Rob and Maria asked me point blank, what is more valuable here, the Roth conversion or selling investments and paying nothing in taxes? And for me to answer that, I went into their financial plan and I showed them, we say the good news and the bad news. And so here's the base version of their plan if they did not sell, let's say that they didn't do any Roth conversions, they just kind of lived life, they took money out whenever they wanted to, and they didn't have a strategy. So good news and bad news here. The good news is that they're going to end up having over $44.7 million left at the end of their life. I mean, that's a nice chunk of change. And the probability of running out of money was very, very low. So great news there. But the bad news is they were going to pay over $1 million in taxes over their lifetime. And the reason why they were going to pay that is because of required minimum distributions. And you can see it right here. In the early phases of retirement, they're in a very low tax bracket. And then just recently with the passage of One Big Beautiful Bill, the tax brackets that you see here today are now permanent. And when they say it's permanent, our opinion is that we'll have 5 to 7 years of this. At some point, there's going to be a future Congress that's going to change this. But right now, taxes are on sale. So whether you choose to do Roth conversions or selling things tax-free, take advantage of these years. We think there's at least 5 of them. We don't necessarily think it's going to be forever. But the reason that their lifetime tax bill's over $1 million is because when required minimum distributions kick in, look at that. They go from the 10% bracket all the way up to the 22% bracket. So for Rob and Maria, when we started to project, what if they did Roth conversions? This is where for them, you can see the red. These are those conversions in the first years. We call those the gap years, the years between retirement and when you start having to take RMDs. And for them, this strategy was going to result in a tax savings of almost $440,000, and their investment portfolio is going to increase by almost $3.3 million simply because there's less tax drag in the future. You can see all that gray area right there. That's the reduced tax bill in the future as a result of paying their taxes now, being really smart with the system. So the answer to the question of what's more valuable to you really comes down to how much money do you have locked away in your traditional IRA or your 401k that's going to ultimately result in a really large RMD, just like the one that you saw here. To be honest, I've seen some other situations where people have a lot more money in their IRAs, and instead of being in the 22% bracket down the road, it's more like 32 or even 35% sometimes. And so for those cases, I think the Roth conversion can make a lot of sense. But as you do a tax projection for yourself, if your future RMDs are not going to be too terrible, then that's a scenario where you may want to lean towards taking tax-free income in the future. And then here's another thing to consider. Here's a strategy that you might want to think about. If you're thinking, well, I kind of want to do both of these things. I like the attraction of 0% long-term capital gains, so saving money now, but I also like the idea of saving over my lifetime in my tax bill, which would be the Roth conversions. Here's a way that you could potentially have your cake and eat it too. If you are like Rob and Maria here, you could sell investments the first few years of retirement. So you're going to pay nothing in taxes. So I'll go back to their base plan here in their financial plan. The strategy for them could be sell those investments from their brokerage account in year 1, 2, maybe even 3 of retirement. Try to keep their taxable income below $96,000. And as they're selling the investment, what they could do, they could just put that in a money market fund right now, which essentially is paying over 4% now at Schwab. Just park that money because they're going to use it to live on in year 3, 4, 5 of retirement. In other words, they could still do the Roth conversions. They could just delay the conversions. So in other words, have your cake and eat it too. Make the sale in your brokerage account, get tax-free, pay nothing in taxes to free up the cash, and then use that freed up cash to enable yourself to do Roth conversions a few years into retirement, so that not only are you saving money now, but you're also saving potentially a lot of money in the future when the tax bill's lower because the RMDs are lower. So I hope that helps. It's not necessarily a cut and dry situation, but I wanted to articulate the logic and the thought process of what's better. Tax gain harvesting, as we call it, paying nothing in capital gains tax, versus those conversions. This may seem very complicated, but it doesn't have to be. But why it's so important to me is that taxes are going to be one of your top 2 expenses in retirement. And right now, taxes are on sale, so I want to help you take advantage of that. And if you need assistance with this, get in touch with me. My team and I would be happy to help you. Best way to find us is seasidewealth.com, or send an email to team@seasidewealth.com. Also, make sure to like and subscribe to the channel and share it with any friends that can benefit from this. Word of mouth is really helping our channel grow. Make sure to pay attention to the next one because we got great content coming for you.